the end of this year. We've had an incredible 6-month run through the second and third quarters of 2020. As you look to the end of this year, is there anything you feel compelled to do within portfolios right now as we set up for 2021?
Well, I think there will be opportunities, especially if, in fact, we get a disastrous November 3rd, polling and election outcome. If there is a contested election or if there's a recount, then I think we'll get some opportunities to go long the markets in specific sectors that we're recommending. Number one, I like Miles's industrials. I think industrials under either scenario, either a Biden or a Trump 2 scenario, are more likely than not to get a bit of a boost from infrastructure spending and economic recovery. Depending on who wins, I think you could see a better bid for non-conventional energy, some of the more democratic leaning aspects, which is, green energy, I would say anything that doesn't have to do with oil or banks. So those are what I would say would be the top picks going into 2021. Again, I think it matters quite a bit who takes home the prize on November 3rd, or how long it takes to determine who is the ultimate victor.
And so I guess in thinking about that, then we saw the market, have such kind of a spotty September, I guess we could say. This week has been better so far. In your view, was that about the markets starting to really price in the election? We talked about it for so long. And then, sure. Obviously the pandemic was a more pressing concern, but it seemed like we waited till Labor Day to really start to understand this was only 8 weeks away.
Yeah, we had a 10% correction in the S&P in most recent trading. We thought that was a buy, so we told our clients to go long the broad S&P and proceed with a barbell strategy, which is, of course, married put options or the purchase of gold or the purchase of tips. I think these continue to be good strategies going forward, Miles. And again, depending on what the market brings us in this fourth quarter, if we get the stimulus package or not, if the Federal Reserve continues to fuel asset price surge or not, that could also give us the opportunity to engage further in the markets in a very pragmatic way, which I think one must do, because my view, Miles, is that this is really a very stimulative environment, which over the course of the next few years, we will see inflation as a result. So that's why I'm telling our clients, look, gold has retraced very nicely after it's massively overbought a position a few weeks ago. It's a good time to go long, good time to go buy tips, time to buy some put options, and even not a bad time to raise a bit of cash.
And so we're talking about a number of the macro trades in the market. We haven't yet mentioned the dollar, which has had such a huge move over the last couple of weeks. And we've talked about it a lot on this program, is really influencing for some time there, day-to-day trading action. It seemed like everything was tied to, a dollar rally or a dollar unwind. How do you see that fitting in to the setup here?
Well, I think long term, of course, the dollar is going to face a weakening trend. But over the near term, if we get a second bout of the virus, or if we get some conflagration with China or a contested election, then the dollar will be near term positive for the dollar. Not to mention, of course, that the DXY is more than half comprised of its relationship with the euro. So if we were to see London close down or Europe revert into economic closure, then of course it would be fuel for the positive for the dollar. But I certainly think over the long term that the higher deficits, higher debt, a monetary policy that's certainly nothing but expansionary. And I think fiscal packages is in the docket. That's coming. That's going to be in the next few months or more. And if one compares this, Miles, the reaction to COVID-19 versus, say, Lehman Brothers or the European crisis, the fiscal response makes those things look like child's play. So I think we do have to be smartly positioned, but positioned to the extent that we continue to enjoy the wake of the Federal Reserve's asset purchase program without missing out on further opportunity costs.
And so you mentioned, that fiscal stimulus, and I don't even know where the headlines stand now, because it seemed like there was a new one every hour during today's session. But you mentioned that it's likely to come to pass. As you think about, excuse me here, if you think about, next year for GDP growth, are you looking at a number 5-6%, something like the Fed has kind of forecasted there?
Well, I think economic growth is going to be spotty in 2020, especially given the base effects. So 1Q -6, 2Q minus 30, 3Q is going to be probably plus 30. 4Q maybe +6. Then 2021, I think, is going to be more tumultuous than a lot of guys are anticipating. I think that the economic recovery is not fundamentally based. And in fact, if you look at, for example, in the month of April, when the Fed first came with its stimulus checks, Miles, the important thing to realize is that a lot of the consumption has been fueled by these checks, by the Federal Reserve zero rate policies, and by the CARES Act and the multiple fiscal stimuli. So I think it's wrong to suspect that there won't be additional stimulus, given that that is what has taken us to these levels. And I think that the government is unlikely to risk a retracement in the economy because we suddenly get fiscally responsible.